Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent labor market report, and we'll also discuss things like Bitcoin and, of course, the S&P 500. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. The unemployment rate actually came in lower than expected, right? If you were to go over to trading economics and look at what the consensus was actually 4.3%, and the unemployment rate came in low at 4.1%. The larger thing to talk about here is that in June of 2025, the unemployment rate, we just got 4.1%. June of 2024, the unemployment rate, 4.1%. So we've now had a year, and apply like a 7-month moving average, right? We've now had a year where the unemployment rate hasn't changed, really. And you could argue that perhaps some of those rate cuts we got last year really helped improve things. So, obviously, policies with the administrations and whatnot. I mean, obviously that has effects too on the labor market, but it's really interesting that the unemployment rate has largely leveled off the last few months, and it hasn't really continued to go up. And so we're going to go through some of the labor market data. We'll talk about, the S&P, we'll talk about Bitcoin, but it is fascinating to me how we have spent so much time just at these levels, and it keeps it keeps feeling like it's going to potentially break up, and then it just never does, right? Initial claims still remain low. We've said many times over the last few years that as long as initial claims are below 300,000, then you don't really need to worry that much about a recession. And you can go look, right? You can go look at initial claims and see that they're now still below 300,000. I mean, they're at 233,000. They have been moving up for the last few months, but even at the beginning of the year, we said they'll likely move up into the summertime because they did the same exact thing in 2024. They moved up into the summer, and again in 2023, they moved up into the summer. So, right, it's not really that different. If you were to apply like a 7-week SMA to initial claims, like you can see they are heading higher. Like there's sort of higher lows from one year to another, but it still isn't really that different than what we've seen, right? At least up until this point, it hasn't really changed a whole lot. And so until initial claims are above 300K, I don't really think the recession that everyone's, that probably will eventually come, right? I don't think it's here until we see initial claims above 300K. And that's something we've talked about probably for the last 2 to 3 years. If we go back to the macro dashboard, you can see a lot of data came in today, like a lot of data. What we're going to do is we are going to go over here and look at the unemployment statistics. So the unemployment rate we just looked at down to 4.1%. So that's a good thing. The thing that's probably going to affect though, and I know a lot of people aren't going to like to hear this, but because the labor market is still doing very well, right? Because it's still doing very well, according to the data, it's likely just going to delay rate cuts and potentially delay the end of quantitative tightening. In fact, if you go to the CME Fed Watch tool, earlier, I believe the odds of a rate cut in July were like 25%. After the labor market report today, they've dropped down to 5%, right? If you look at probabilities, the odds of a rate cut in September are still more likely than not, but this used to only be like a 5% chance or something in September that they would not cut rates. And now it's almost a 30% chance that they won't cut rates. And I think the argument is somewhat obvious, right? Like the argument is just simply, well, if the unemployment rate is going down or going sideways, then what's the urgency? Now, obviously, if we want to get into the political side of things, I've seen the arguments like, well, if Powell cut rates last year with higher inflation, why is he not willing to cut rates this year with lower inflation, right? Like, I'm not trying to dismiss that. I mean, let's go take a look. If you had inflation rate year over year in 2024, right, they were cutting rates in September, right? Last year, September, and then I think they cut rates like 3 or 4 times last year. Um, and so if they were willing to cut when inflation was up here, then like why are they not willing to cut right now? Well, the reason, right? The reason they're going to give is just simply because Powell said it the other day, right? They're worried about how tariffs might affect the data, right? That's what they're worried about. I don't know how much tariffs are going to affect the data. I really don't. I have always been in the disinflationary camp. Like I've always been in it's a stochastic process, but we should see this disinflationary process. And that went against a lot of what people are talking about, how it was going to be a repeat of the 1970s, right? I've been very clear. I don't think we're going to get another major spike like this. I think it's possible that you get a temporary spike, potentially caused by tariffs, but who knows? But I don't think it's going to be like the 1970s, right? And so I guess the risk here, right? The risk from the macro perspective is that what if Powell is waiting for this tariff spike that may come, right? I'm not against I mean, I wouldn't be surprised if it occurred, but what if he's waiting for this to occur for more rate cut, or, and that's why he doesn't want to cut rates, but then it just never happens. And, they run the risk of cutting rates too late. But that's the argument, right? That's the argument. I think the issue right now is that when you look at the unemployment rate, back last year, the unemployment rate was trending higher, right? And when they cut rates, the unemployment rate had just gone to like 4.3%. That was later revised down to 4.2. But if you guys remember last year, we did get a print sometime in the summer months, I believe, of 4.3, and then they later revised it down. So they cut rates, but you can see that the unemployment rate has mostly stayed steady for a while now. The other thing, too, the way that you get major downturns in the economy is by you have lower stock prices, right? It's not the economy. It's not like the data is going to come in and then tell you the stock market's going to crash, right? Like the stock market will crash and then the data will start looking bad. But we talked about this, right? If you look at like the S&P divided by M2, this is a very similar move as to what we saw back over here in 1998. And we actually tracked this very closely, this 20% drop, 20% drop, and then it basically just blasted through. And the point is that it blasted through and it did not, the economy did not roll over into a recession until much later. Now, the thing that you have to keep in mind, you might say, well, hold on a second, Ben. The labor market this time has been trending up, whereas over here, it was actually trending down during this 20% drop. So why is it playing out in a similar fashion? I think you could argue that the unemployment rate right now at 4.1% is basically still at a level that is lower than where it was when that recession actually occurred back then, right? It's still at a lower level. So again, the unemployment rate went so far down this cycle, there's been so much more wiggle room, right? So much more slack to let out that it's just taking a very long time. And so what ended up happening with the S&P 500 is that it played out exactly like it played out over here in 1998. It rallied up to this level. It then got a big correction, and then it just rallied right back up to put in a new cycle high and a new all-time high. You see that? It's following basically a very similar path up until this point. In fact, it's so similar of a path that if you were to take a bar pattern and just take it from this low, right? If you were to just move this over to the low in October of 2022, it's almost the exact same thing, right? Like you can't even really tell the difference. Even the 20% drop occurred around the same time, right? I mean, it occurred around the same time. And so it's really fascinating to like see that. Now, that doesn't mean that it's all going to play out the same way. Like it doesn't mean that you ever have to get this major crash, right? You might not. It doesn't mean that you have to go this high before you get another pullback. I mean, there are times, right, where like the S&P will drop a lot, it'll rally back up to a new high and then just drop again, right? So there's no guarantee. But the reason why this has been able to go back up is because the unemployment rate and inflation has been okay. What have we said for years now? Risk assets generally go up unless they have a good reason not to, right? So we don't need to search for a reason why, they need to go. Sometimes we talk about, like, we'll talk about when there'll be pullbacks, right? Like, and we said there's going to be a pullback between February OPEX and early April. And there was, right? There was. And then we said there's likely going to be a counter trend rally at the very least in Q2, could lead to new all-time highs. And it did. I think the next low is going to be August, September. And the thing, the thing with this is that people say, well, like, why do you talk about that stuff? Because you don't need to figure out reasons for the market to go up. It just goes up. You have to find reasons for the market to go down. And that's kind of what, the larger points to discuss, like what would cause these things to drop. And the three main things are the unemployment rate going up, inflation going up, or geopolitical events, right? Those are the three main things that would cause that stuff to play out. And so, we have this unemployment rate that's gone up, but it's kind of just gone sideways for basically the last year. And we haven't really seen a major increase. And so again, because of that, now you're seeing these probabilities shift once again. Now there's a 95% chance the Fed is going to hold rates constant at the next meeting in late July. A 95% chance. And a lot of people are not going to like that, right? They're going to complain about it, and they're going to say, well, if he cut rates last year, why won't he this year? I'm not completely unsympathetic to that view. Like, I think that, it's not like, it's not completely unheard of, but I will show you the risk, right? If we can, for a moment, if we can just kind of say, like, is there a risk? And I'll show you what I'm talking about. Look in 1998 to 2000, right? Look at this 20% drop and then the rally back up. Now, you might be surprised to know that back then, interest rates actually dropped from about 5.5%, or sorry, what was it at? 6.5%? No, I'm looking at the wrong thing. I need to be looking at this y-axis. So they dropped here from 5.5 down to 4.75. Right here, they dropped from 5.5 to 4.5. And you might have assumed that the Fed would have continued to cut rates, but instead they ended up raising rates again as the animal spirits returned, right? So that is what Powell, I think, desperately wants to avoid, right? I don't think he wants to leave the Fed chair in 2026, and inflation starting to get out of control again, because I feel like he's going to have left thinking like he didn't do a good job. So I think he's worried about something like that, where they cut rates too aggressively too soon, and then it could be great for stocks in the short term, right? It could be great for risk assets in the short term, rate cuts and whatnot. But the problem is if you don't actually need the rate cuts, right? If you think about it, the S&P 500 is at an all-time high. Bitcoin is really close to an all-time high. The NASDAQ is at an all-time high, right? I mean, a lot of stocks, Nvidia is at an all-time high. If you have all these things at all-time highs, and if the economy is so strong, and the unemployment rate's trending down, and the Fed's worried about this tariff inflation, then you can kind of understand why they're not willing to cut. And I feel like there's this argument, and I struggle with it too, right? I mean, I feel like you could cut rates, and I wouldn't be against it. But I think there's this idea of like, oh, well, this is a great economy. This is talked about a lot, right? How great of an economy it is. And according to the labor market, the economy is still doing fine. But if it's such a great economy, then like why? And if risk assets are at all-time highs, like why do you need rate cuts, right? I mean, obviously people want them because they want, they want their assets to go up. And if they're cutting rates for not a bad reason, right? If they're cutting rates just because to try to get ahead of bad things, that's good for risk assets, generally speaking. So obviously people want rate cuts because they want the assets that they own to go up. You don't want to see rate cuts that are too late, because if rate cuts come and they're too late, then the rate cuts aren't going to do anything for your assets, right? Like the market gave up, and like you can see in 2000, they had all these rate cuts. It didn't mean a thing. The market just collapsed, right? Same thing in 2008. So with Bitcoin, you've had this run up to 110. Now, I'll be honest. Like, I mean, I've talked a lot about thinking that we would probably have some type of a pullback in Q3 around the August to September timeframe. That's been my base case, sort of a pullback into August, September. But I could be wrong about that, right? I was basing that on the idea that the unemployment rate would go up a little bit more this summer. And the reason why I said that was because if you go look at just the last 2 summers, that's when the unemployment rate did go up, right? In the summer of 2023 and then going into the summer of 2024. So I was thinking, all right, well, the unemployment rate might go higher into the summer like it did the last 2 summers. And if it does, that would be a reason for Bitcoin to get a pullback before then heading higher again a little bit later. But we're not getting that. And so, what did we talk about earlier? In order for these assets to go down, there needs to be a reason for them to go down, right? The labor market's not really given that reason. The other thing that might provide a reason would be the inflation rate, right? If inflation comes in hot, then that could lead to a pullback in like the August, September timeframe. But I want people to know that, I put out these predictions and some of them come true and it feels good when they come true. And then some of them don't, right? And in this case, I can't know. I'm actually about to be out of town for a couple of weeks, so I've pre-recorded some videos that I'm going to release, but I'm probably not going to be available much to provide commentary on the markets over the next couple of weeks. And so I don't want you to think that like I'm avoiding talking about like, all the volatility that might be coming our way. It's just I'm not going to have as much access to the markets to even talk about this stuff or to record things or anything like that. So what I would say with Bitcoin, and I've continued to say this for probably the last 3 to 4 years, is that I don't know where the market's going to go. I do know that if you're going to have exposure to something in crypto, Bitcoin is the better play than basically everything else. And so Bitcoin gives you exposure to the upside and it minimizes your downside risk. So the argument, and I said the same thing back over here in early 2025, the argument is that there's a good chance that Bitcoin was going to go down into March, right? But the argument that I made was that even if it does, it'll still likely come right back up to these prices later this year, right? And so you don't necessarily have to, look, I drew a little happy face. You see, you don't necessarily have to worry that much about it as long as you're willing to ride through the volatility, right? So in this case, I think I would make the same argument that if there is a pullback into August, September, there would still likely be another bounce later this year, in the worst case scenario. There's always a chance that Bitcoin just breaks up. I'm not going to be able to make a lot of videos on this over the next couple of weeks. So what I'll be watching, though, is, I guess, I'll be watching this trend line here to see if it breaks. If Bitcoin can break through here, then you might still have a pullback later on, like let's say August or September, but it could be to a higher price than we currently are, right? If we get rejected here, then the main area to watch would just simply be the bull market support band, and then sort of a worse scenario would be that 50-week moving average, right? The 50-week SMA came into play in Q3 of 2023 and Q3 of 2024. We hit it this year as well already in late Q1, early Q2, and now the question is do we need to hit it again, or have we already gotten that out of the way for the year, right? So that's where I am right now with this, is that like I think that, if Bitcoin does drop in Q3, there would still likely be another bounce on the other side of that, and it could always lead to a lower high, but that would be sort of like the worst case outcome. And the best case outcome is just it breaks through here and then finds support there later on this year. So again, the whole idea is that Bitcoin gives you exposure to the upside. It minimizes your downside risk. If you look at alt Bitcoin pairs, one of the side effects of an unemployment rate that's coming in where it's coming in at 4.1% is that if the economy is truly that strong, and that's the way the Fed's probably going to interpret it, then why do you need rate cuts? And why do you have to end quantitative tightening? Well, the answer is you probably don't. And you can see that the market probabilities have already taken that up to 95%. right? 95.3%, they're going to keep rates steady at the next meeting. And so because of that, you could argue that, because monetary policy is not going to significantly change in the next month, and really the next month after July for a meeting is not until September, right? So we don't even have a meeting in August. So I think the argument here is that if you're not going to get a rate cut in July and you're not going to get a rate cut in August, that means the earliest the next rate cut could come would be September. And if all Bitcoin pairs are already bleeding with where rates are, this has just been a slow and steady bleed. If they're already bleeding and monetary policy is not yet going to change, then why would they not just bleed to the range lows, right? And I think that is the ultimate outcome. It doesn't have to be immediate, right? You can see in June of 2023, there was a little bit of a bounce. In June of 2024, there was a little bit of a bounce going into July. So maybe you get something like that. But if you look at 2019, there was a little bit of a bounce in July, and then they went to the range lows by September, okay? So, I would prefer to just rip the Band-Aid off on these alt Bitcoin pairs. But again, the argument is if the economy is doing fine, why do you need rate cuts, right? I'm playing devil's advocate as to why the Fed is thinking this, right? If the unemployment rate is going down and stocks are at all-time highs, they're not going to be as likely to cut rates. And if that's true, it likely just kicks the can down the road a few more months on rate cuts and the end of quantitative tightening, which means that the most likely direction for all Bitcoin pairs is down. I had someone say, and a frequent thing that I get is people say, why are you so negative all the time about this stuff? And I'm like, guys, your brain is wired incorrectly, in my view, if you think Bitcoin dominance going up is a bad thing, right? It's not a bad thing for the best asset in the cryptoverse to take on more market share. If you think that, then I feel like I have failed you, right? I feel like I've completely failed you. And I don't know, how for people to think differently in this situation, but if you're looking at this chart, this Bitcoin dominance chart, and you're looking at it and you're thinking, this sucks, right? It's terrible. You need to rewire the brain to think in terms of Satoshis. If you think in terms of Satoshis, this is the best chart in the world, right? The other thing that I want to say is don't trade the market that you want, trade the market that you have. And I've learned that lesson many times, right? Don't trade the market you want, trade the market you have. So a lot of people keep saying, well, you want alt Bitcoin pairs to go. I'm like, well, Ben wants this to happen. Well, I'm saying it's the most likely scenario based on monetary policy and based on the idea that alt Bitcoin pairs are oscillators at best. It has nothing to do with wanting something, right? It's just that I think is the most likely outcome based on where we are. If monetary policy were different, my views would probably be different, but they're not. So my views are not any different than they have been for a long time. So, that's kind of what I'm thinking with regards to, to the stock market, to all Bitcoin pairs, obviously to Bitcoin USD as well. And, if you look at some, we're not going to go through every single chart here, but if you look at some of the other statistics on the labor market, if you look at the number of states where the unemployment rate is rising over the last 6 months, it's at 24, right? And it's been putting in higher lows, and last year was not a higher high, but it has been putting in higher lows around April, and then again here in April, and then again this year in March. But it still isn't all the way up at 50 and staying there like it has in prior major downturns. If we were to go look at total temporary help services employees, it seems like it's potentially starting to level off here. I think they must have revised some of this because it didn't look as good last month. I think maybe there were some revisions there. Job openings went up. That's a good thing. This is another thing. If you look at it on a 7-month moving average, it looks like it's just kind of leveled out, right? So future rate cuts, as long as the economy holds up okay, might actually cause this to start going back up again, which you could argue we might want to see happen soon, right? I don't think job openings going up would be a bad thing. because you can see there was this trend line we were on, and it seems like we've fallen off of that trend line a good bit. So yeah, I mean, I think there's an argument that, why not throw in a rate cut just to get ahead of it. And it's not a bad thing for the stock market to go to all-time highs, right? And if they cut rates and the stock market goes up, that's a good thing. The problem is they cut rates too soon, and it leads to the reacceleration of inflation, right? And I think that is why the Fed is a little bit timid. Hires actually dropped a little bit, not a lot, but it is, they dropped a tiny bit. Initial claims, as we said earlier, are still pretty low, right? Nothing that concerning up until now. Layoffs dropped. So, I mean, again, you see the headlines for layoffs, but really they're no different than basically the historical average. Job quits rate went up a little bit. That's a good thing. It means more people are more likely to quit their job. So maybe they have a better, maybe they're more successful getting other jobs, which is why they're quitting. And one of the charts that Powell has sometimes referenced is the where is it? Under save charts. Oh, I guess I need to. Maybe I deleted it. I don't know. But basically, it was job openings per unemployed worker, I believe. Job openings. And then if you just go to like the unemployment level, so then you could add it. You have these two charts, and then you just say unemployed persons per job opening. So we add a formula, and we just say M2 divided by M1. You get this chart, and then we can remove these. Oh, I did it backwards, didn't I? So is this M2? Yeah. So you can see that like the number of job openings per unemployed worker is basically back up to 1.07. So still theoretically more job openings per than unemployed workers, and it's trying to hold right at that one level. So you could argue that Powell is doing what he thinks he should do. I get there's a lot of political commentary that come along with that. Well, if he's willing to cut in 2024 when inflation higher, why is he not willing to cut in 2025? I think maybe he's just worried that inflation is going to reaccelerate. I'm not saying that it's going to, but I think that's what he's worried about. Which is possible that it would cause them to hold rates too long. That's always a possibility. If you're to go look at just to show you the statistics on the recession stuff, like if you looked at the smooth recession probability chart, only a 1.6 chance of a recession in May. Or this past May, there's only about a 1% chance, 1.64% chance that we were in a recession. I'm going to guess that might come back down a little bit, mainly because, we didn't spend a lot of time. Remember, one of the things we said is that in order to get a longer recession, you have to spend a longer time at lower stock prices. But if it just comes back up and puts in a new high like it did here, then it's likely not going to be enough in and of itself to produce a recession. And it hasn't, right? It hasn't. SOM rule recession indicator dropped a little bit more. Number of states where the SOM rule is triggered, it's been going back down. Coincident economic activity index is going up, still at a fairly robust pace. The only thing was that the ADP that came in kind of low this month. It's never really a great indicator of the other labor market report, but a few days ago we got this chart, so it was a negative print, and you can see that's the first negative print we've had since on a month-over-month basis since March of 2023. See, negative 53,000 March 2023. This was negative 33,000. That's total private. If you look at construction, it went up. Right. If you look at education and health services, that one's starting to really roll over here. Right. So some of them are starting to look a little weak, but again, this is the overall. I mean, this has not been a great indicator of the other labor market data, right? The ADP, the Automatic Data Processing Research Institute, has not really been a great indicator of the other stuff that we're measuring, right? Like the job report that we just got. In fact, total non-farm went up 147,000. Right, this continues to be relatively robust. If you were to look at, this is the establishment survey. If you look at the month-over-month comparison, it hasn't gone negative. The lowest it was at was October 2024 at 44K, at least in this business cycle. Still fairly robust right now. We could look at construction, still doing fine, right? In fact, it looked like it was starting to level off, and then now it's moving up again. If we go back to total non-farm, we go to the household survey, that also increased, right? It also increased a little bit. A year-over-year change shows that it did go negative for a little bit in late 2024, but then it's been positive basically ever since. So all in all, the labor market has continued to do okay. I think the major risk right now that the Fed's worried about is, are you going to see inflation start to go back up again? In fact, if we go find it, prices, inflation rate year over year, it's starting to go up a little bit, but not that much, right? And I guess the argument is the Fed cut last year in this range here when inflation was going up. So why aren't they doing it now? I guess because of tariffs, as they say. I guess because of tariffs, but very similar thing. All right, guys, that's the report for this week. Again, I'm going to be gone for the next couple of weeks, so I have pre-recorded some videos. So if you're watching it and you're like, why the price? Like, why is Bitcoin at this price? It's not at that price. It's probably because I pre-recorded it. So just going to release those while I'm gone. But so if you're wondering, like, if Bitcoin if it's at 120K, why hasn't been talking about it? It's because I'm out of town. Or if it drops, if it drops back down to 100K, like, why has been not talking about it? It's because I'm out of town. I might try to make some videos, but I don't really think I'm going to be that successful at it. Anyways, guys, we'll wrap it up there. Thank you guys for tuning in. Subscribe, give it a thumbs up. And again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. I'll see you guys next time. Bye.